and welcome to the Money Talks with Andy channel. So today, following on from last week's video where I discussed what an asset is, and hopefully you know what an asset is. If you haven't, please check out the previous video. Today I wanted to discuss something critical for property investors, and this is the absolute minimum everyone needs to know, and not just property investors, just investors in general. But today we'll focus on specifically rental properties. So, what is cash flow specifically applied to rental property? And the reason cash flow is so important is because it can really make or break your property investments. Okay, now basically, cash flow is either positive or negative. It's one number, and it's so critical that if you get this number wrong, you will bleed money. You will lose so much money, you could lose your shirt and eventually go bankrupt. And no one wants that. So it's very important that you do the calculations and make sure you know what you're getting into. So basically, the cash flow calculation, it's a basic calculation, but you do need to put in the time to understand each element that goes into the calculation. But ultimately, it's just add up all the income you receive from a rental property, followed by deducting all expenses relating to that property. Okay, and the net figure is either positive or negative, and that's basically whether you're in a positive cash flow situation or the worst, which is a negative cash flow situation. So, a very quick sample calculation I put together might look something like this, where you get your income, which is typically your gross rental income of whatever it is, and this could be per month or per year or however you want to calculate that. That's up to you. And then you deduct all your expenses. I've put property taxes at the start because this is something that many people overlook. Many people usually put something like mortgage interest, which is the top of their list, but they forget about everything like property taxes or management fees if you're not managing it yourself, or maybe you have to pay some kind of management fee for the housing association, or some kind of shared area, or maintenance, repair costs, insurance costs, any other expenses that you can think of. So you add all the expenses up, and then you see what the difference is between your rental income, the total or gross rental income, less all the expenses, and then you get either a positive or a negative figure, and that is your cash flow. Either it's positive or negative. So if we are talking about an asset, we definitely want this to be a positive figure. My personal preference is it's got to be above zero. Zero is the absolute minimum. If it's a zero, it's not actually positive, in my view. Some investors don't mind if it's zero cash flow. Personally, I don't think that's a good enough a deal. But my red line, which I will absolutely not accept, is a negative figure. So even if it's negative by 10 cents, 50 cents, a buck, that is not acceptable. You cannot be losing money on an investment. It doesn't matter what the investment is. If you are losing money, it is not an asset. Okay, so I hope you understand what an asset is. I hope now you understand what rental property cash flow means and how important it is for this to be a positive figure. So I hope you enjoyed this video. Please give me a thumbs up, subscribe to the channel, and drop a comment if you have anything to say about this video, or if you'd like to see any topics covered in the future. I look forward to seeing comments. And with that, I shall see you in the next video.